So you run a business, right? That means you're constantly buying things. But when you do, how does it show up on your books? Is that purchase an investment that's going to build value for years to come? Or is it just a cost of doing business right now? That's really the heart of what we're digging into today, how to think about the things you buy for your business.
Okay, let's make this super real. Picture this. You just pulled the trigger on a brand new $50,000 machine. That's a huge investment. But, as you know, the spending never, ever stops with the sticker price, does it? All of a sudden, there's this whole new wave of bills coming your way, all tied to that one single purchase.
You've got the delivery charges, then you have to pay someone to install and set it up. Of course, you've got to train your staff to actually use the thing. If you took out a loan, you've got those origination fees. Oh, and don't forget sales tax and maybe even some specialized insurance. People call these soft costs, and they can easily tack on another 20, even 30% to your total bill. So what do? Do you just lump all of this into the machine's price tag, or do you have to handle them differently? To answer that, we have to go back to square one. We need to look at one of the most fundamental ideas in all of accounting, the difference between an asset and an expense. And trust me, this isn't just some boring technical detail. It completely changes the story your company's financials tell the world. So look, every purchase can go down one of two roads. On one hand, you can capitalize it. Think of this as calling it an asset. It's an investment in the future of your business. It goes on your balance sheet, which is kind of like a snapshot of your company's net worth. And you spread that cost out over time through something called depreciation. On the other hand, you can expense it. This means you're treating it as a cost you consumed right now. It hits your income statement, which tracks your profit, and it reduces that profit for this year all at once. So how do you decide which path to take? It's not just a gut feeling, that's for sure. There are actual rules to this game, and they're pretty clear no matter what kind of business you're in. First off, let's just be clear on what we're even talking about. A capital asset is basically any of the big stuff you buy that you plan to use to run your business, not something you're going to turn around and sell. It's your delivery trucks, your computers, your office furniture, and that big machine we keep talking about. It's a tool that's going to help you make money for years. And this brings us to the first super clear bright line rule. To even be considered a capital asset, an item has to have a useful life of more than 1 year. If you're going to burn through it in the next 12 months, it's an expense. Simple as that. End of story. The second rule is all about the price tag. Your company gets to set its own minimum cost, say $5,000. Anything that costs more than that, you capitalize. Anything less, you just expense it, even if it's going to last for a decade. Really, this is just a practical rule to keep you from having to track the depreciation on every single office chair you own. Now, that number varies. Big institutions like Harvard University or Stanford often set it in that $3,000 to $5,000 range, so you just have to decide what makes sense for your business. Okay, so those are the black and white rules. But you and I both know that the real world of business is full of gray areas. So let's dive in and tackle some of the most common spots where people get tripped up. Let's go back to that new machine. You just spent a few $1,000s getting your team trained up on how to use it. And let's be real. Without that training, the machine is just a giant, expensive paperweight, right? So it feels like that training cost should be part of the machine's overall value. But can you actually do that? Well, the short answer, and someone on Reddit put this perfectly, is a hard no. Nope, you can't. The accounting rules are really, really specific here. You can only capitalize the costs that are absolutely unavoidable to get the asset itself to the location and in the condition it needs to be to work. And here is a brilliant way to think about it. I'm calling it the coffee expense test. Think about it. If your employee needs coffee to be alert enough to operate the machine, would you add their daily latte to the machine's value on your balance sheet? Of course not. That's ridiculous. Well, training is the exact same logic. It gets the person ready to work, not the asset. That's why training is always just a regular operating expense. All right, let's tackle another super common one that trips people up, especially these days: software. You know, it feels like a long-term thing, but sometimes you own it outright, and other times you're just paying a monthly fee. So what's the deal? The rule here is actually pretty clean. If you buy a perpetual license, meaning you buy it once and you own it forever, like some big custom software system, you capitalize it. It's an intangible asset. But if you're paying a subscription fee for something like Slack or QuickBooks Online, that's what we call software as a service, or SaaS. You're just paying for access, you don't own it. And that makes it a regular operating expense. Okay, listen up, because this next one is probably the single biggest trap I see business owners fall into. Your financing company calls you up, And they say, hey, no problem. We can roll the delivery, the installation, and all that training right into one nice, easy monthly payment. And it sounds awesome, right? It's so convenient, but it creates a massive and honestly, a potentially dangerous confusion for your bookkeeping. So if you take only one thing away from this whole explainer, please let it be this. Financing and accounting are not the same thing. They speak two different languages. Financing is all about cash flow, making a big purchase more affordable. Accounting is about principles. It's about defining what a cost truly is. So just because your loan bundles everything together doesn't change the fundamental rules. Training is still an expense. Delivery and installation are part of the asset. The accounting rules don't change, no matter what your loan statement says.
Now, you might be sitting there thinking, wow, this sounds like a huge headache just to keep the accountants happy. But getting this right has a massive real-world impact on your business's health and your strategy.
And look, these aren't just some random rules for small businesses. These exact same principles apply whether you're buying a laptop or you're building a multi-million-dollar cargo ship. They are part of a global set of accounting standards, the stuff that allows investors to accurately compare a company in Brazil to one in Germany. It creates a level playing field for everyone. And for your business, the story these numbers tell is absolutely critical. Think about it. If you expense a massive purchase all at once, you could make a very profitable year look like you actually lost money. This decision directly impacts your tax bill. It changes the official value of your company on your balance sheet. And maybe most importantly, having accurate financials leads to you making smarter decisions for the future. So getting this right is about so much more than just being compliant. It's about telling the true, honest story of your business's performance and its value. It means the next time you're about to sign off on a major purchase, your first question shouldn't just be about the price tag. The real question, the much more powerful question is, where does that cost belong? Is it a cost for today, or is it an investment in all of your tomorrows? Answering that one question correctly, well, that's one of the keys to building a business that's truly built to last.